So again, everyone, welcome, and I'll take the next 25 minutes, 20 to 25 minutes, and go through a couple of things. We're going to talk about disciplined growth, risk management, which is what Alpha V is known for. We'll give you a background on Alpha V and talk about where we see 2026 going and how to be prepared for what's ahead in 2026. I want to start off though and remind people at alphav.com, we have kind of two divisions and a right side and left side of our brain, if you will. So today on the right side, we're going to talk about the investment strategies and for wealth and asset managers, but it's all underpinned really by technology, which is a requirement today to be a successful manager. And our workstation platform, it's all our own code and technology that we built over the last 15 years with shit, 10, $15 million invested in it. And so they work side by side. Our analysts, portfolio managers use that software day in, day out to help thousands of advisory accounts, thousands and thousands that depend on us. So please go over to alphav.com, click on either the right side or the left side, depending where the interest lies. So Alpha V has been providing institutional caliber models and portfolios for RIAs for many, many years. We're really focused on fundamental based research. The fundamentals are really evidence based, tried and true approach. And the most important thing is these kinds of strategies keep your clients invested because when you combine that I'm going to have a bunch of these kind of quotes and common things I repeat over and over to advisors and those of you that have seen me on different webinars and videos, etc. When we combine these fundamental, boring income statement, balance sheet kind of insights with our proprietary signals, we're able to build very powerful portfolios for advisors, for your clients, and allows you to, if you will, outsource a lot of this risk management to the Alpha V side and really without sacrificing any oversight. We've been named as a top provider for SMAs, for indexes in a lot of our portfolios over the years. And really, why I think a lot of advisors choose Alpha V is advisors face really two forces, right? Your clients are demanding very strong returns, but fear any volatility or risk. And what we do is provide you a strong, simple to explain framework that'll keep your clients invested. And that's really the number one driver of those long-term returns. So we all know the clients fear volatility and emotions often drive a lot of timing mistakes. And a lot of advisors have used buy and hold, or what I call buy and hope strategies, where they're fixed static allocations. And when market leaderships rotate, they just don't rotate in an efficient manner. Advisors also need something simple to explain, to reduce the panic, to keep the phone from ringing. So I often say it's not the market that ruins portfolios, it's the reactions to those markets that really ruin the portfolios. So that emotional selling during those drawdown events, and they're going to happen, and we're forecasting in the first half of this year, there's going to be a drawdown event. So we don't know absolutely when. We know it's coming, and we're not sure exactly when it's coming. So how do we keep clients in their seats when sheer fear shows up? Let's talk about that today. So really, Alpha V is a growth engine for your practices, for your clients. We're going to provide dynamic rules-based exposures. This isn't guesswork. It's not emotional. We're going to explain it in the next few minutes. We provide a bunch of risk overlays. And the way we kind of break it down to explain it simply is first we look at the market and allocations. We look at the inflation regime we're in, what sectors we believe will accelerate in the next just 90-day period. And then that's really where our ETF models stop. And our equity models carry on to actually pick individual names in the portfolios. So we're looking for that concentrated leadership and allocate to what's working now. And then what we're also recommending in 2024, 2025, and again in 2026, global diversification. I'll repeat it a few times, keeping client assets in one country and one currency is a risk that we can avoid. So we want to respond to data, not emotions. When leadership rotates, we want to rotate into that leadership. And when risks continue to rise, we want to get into a defensive posture. Be systematic, be unemotional, stick to rules that we know work, and keep something very simple and explainable to clients. So let's talk about what's up next. What's beyond the horizon for 2026? We're big believers in diversification. As we talked about in 2025, we're talking about it again in 26. Diversification just looks different in these 2 years. And the coming year, we think it's going to be a repeat again of 2025. You got to be prepared. So there's a few core strategies. Really, the risk managed large cap in particular, there's two types. There's an ETF only one that we alluded to, maximum 6 ETFs. Clients own half the market, highly diversified, simple to implement. There's a large cap version that has all of our risk lenses turned on. We'll pick the actual names, 50 names across those 5 sectors. And again, the 5 sectors of the half of the economy we believe is going to accelerate in the next 90 days. So it's quarterly rebalance, quarterly reconstituted. So that's risk managed top 5 sector. Now, it's not just the 5 classical sectors of the market. We add in a moderating component, an ETF that's a U.S. Treasury ETF. So this is a multi-asset and also a multi-factored portfolio. Then we bring in a percentage because, again, our belief in my statement, I stick to that having one country and one currency for your clients' portfolios is a risk. It's important to have global diversification, increase that diversification, and do it in an easy, explainable way. So we built and run a portfolio of just 3 ETFs, very unusual in that we have developed market exposure, emerging market exposure, and the unusual part, we use U.S. Treasuries, our favorite intermediary IEF, the 7 to 10-year intermediary, and that's a moderating force. And then we use our signals tilting between these 3. So this risk management framework for the top 5 sector, let's peel the onion and go into it a little bit more depth. We use something called the Alpha V market indicator, where we're rolling up the whole market of 1,500 leading companies. We're doing a temperature check every 2 weeks. Ultimately, at the end of the quarter, when it's rebalance time, we're going to do an allocation and determine how much equity exposure we want, how much treasury exposure we want. We apply up to 4 risk lenses. So on the equity version of this, which by the way is a $50,000 account min, it's 48 basis points, we look at the market, inflation, sector, and selection. The ETF version, which by the way, again, has only a $5,000 account min and is 38 basis points, is market, inflation, and sector based. And we're buying just sector ETFs. So that's really the difference between these two. You could tax loss harvest more easily out of the equity version. We do get some selection alpha most years out of it, almost all years out of that. The ETF, again, 6 ETFs, easy to implement, low account min. So just those are the differences at the high level. So we select those top 5 sectors from another indicator called the Alpha V sector indicator. So we have the AVMI market indicator, AVSI sector indicator. So that's our dynamic core equity recommendation. There's a lot of levers being pulled. We're doing that work for you, for your clients on your behalf. And again, if the market changes, if inflation risks increase, we're going to reduce market exposure, keep everyone invested without going into cash. Again, a little bit more depth. Think about it. When you're talking about market exposures and that risk lens, when the market goes down, most stocks, even great ones, go down. So we use the market indicator to determine what kind of exposure we want. On the inflation side, the rule is quite simple. If we're in an elevated inflation environment, instead of using those intermediaries, we'll use tips. Again, a little more income, and it's more stable during those periods. On the sector side, again, we have the sector indicator that's doing all the peer group rankings and looking deep. And when a sector goes out of favor, even again, most companies, good companies or what have you in that sector will fall. And we want to steer away and rotate into sectors and stay ahead of that and be in the sectors that we believe are going to accelerate. So we use the AVSI for that. And then fundamentally, and that's where the ETF version stops because we just buy those 5 sectors. But if we continue on, we'll pick the leading companies we believe, benchmark weight them, and select a portfolio of 50 names across those 5, what we hope are leading sectors. Now, like we said, every quarter there's an allocation that goes on. So some quarters we could be 60-40 equity to bonds. We could be all bonds or all equities and variations, as you see in this matrix on the bottom left. Then we do our inflation overlay, the sector risk overlay, and finally a selection risk overlay, and go through and pick names, market cap, eligibility criteria, check for liquidity, do a weighting. So these 3 are for the ETF. All 4 is for the top 5 large cap equity. By the way, we have a small mid cap and a small cap as well. Now, talking about International Dynamic. International Dynamic, again, it's a portfolio. It's also systematic. It's risk-based. It's an institutional caliber approach and has worked incredibly well. And as we said, and as you heard on my videos, if you're following me, 2024, 2025, going into 2026, it's really the same where this is a portfolio. It's very simple to implement. 3 ETFs. There is no direct U.S. equity exposure. There is no direct U.S. equity exposure. This portfolio is going to use just 3 ETFs using our signals coming out of the data and the system that we built. And we're going to tilt that portfolio quarterly towards either developed ETF, some percent in the emerging, and then US ETFs. And each quarter, we're going to change those tilts based on the signals. And at the end of the day, this is what everyone wants to know. Sounds greatly. How has it worked? When the rubber hits the road, how have we done? So results count. I thought I'd put up one screen. Great to see from yesterday's close. We're already generating alpha across the board. And you can see International Dynamic closed out a great year, 34%. The large cap also, and the large cap I saw this morning hitting another 52-week high, really doing well, over 28%. So let's hope it keeps going. What's the difference between the large cap and the ETF version? Again, you can see selection alpha, picking actual names. And the other part to this in risk management, we're happy to trade off some performance, which I know isn't a common thing people will say out loud, but in this kind of portfolio, the yin and the yang is we're happy to trade off some performance if I can get lower standard deviation. So we don't want to have a volatile ride. We want to keep the clients in the seat. We want you to show the value you're delivering with the risk management. We want to keep the phone from ringing during these drawdown events, which are going to come, and you must be prepared for this. So as I look back, what are the top performers in 2025 and the actual numbers? We can see it's been foreign and emerging markets. U.S. stocks lagged. However, if you use one of our approaches, you saw we way outperformed, 9% alpha over last year in U.S. stocks and the other metrics. So it's a different approach. It's a different kind of program towards risk management, combining these two, staying very, very diversified. So global diversification, finding the sector leadership, using U.S. Treasuries intelligently in a dynamic mode. I often use this statement that markets are dynamic. Your portfolios have to be dynamic, the client portfolios. And again, it's a simple, easy to understand message for a client, and they'll see how it works and see how it's implemented over time. This really will help with the emotional selling that can happen, improve client retention. So one of these portfolios gives that very disciplined sector leadership. The other one gives you the high conviction quality globally. And together it gives, I think, what clients want, a ride they can stay on and not worry about their money. So advisors tend to use us as that US core equity replacement over what they've traditionally used. Keep in mind, it's equities plus treasuries with this global diversification. And it's very transparent, by the way. You can go on alphav.com slash strategies, look at the strategies or update end of day every day. There's published methodologies. We explain in writing exactly how we manage these portfolios. There's never a style drift with AlphaV. There's, of course, the Morningstar ID on there, a Bloomberg ID. We also have tickers. My favorite place, again, you can go to a lot of these websites. I tend to go to CNBC, and you can just go to CNBC. You can see we hit a 52-week high again today. Click on that link there and look us up and look up our other portfolios. So that's something I think interesting and different. There's an audit report on the website for all of our main portfolios and easy reporting. Now, what do I mean by easy reporting? Advisors that work with us get the benefit if you need custom statistics, custom back tests where you want to combine it with something else other than AlphaV. We're happy to help, happy to work with our all of our clients and partners. So hopefully this approach makes sense. It's logical. It's something interesting. And as I said, results speak for themselves. Typical kind of example allocations, a moderate portfolio generally will be like a 50-50 split. Growth would be an 80-20 oriented split. And again, that all gets customized based on household risk scores and where you're the guardian of the client's assets, and we'll work with you to find something that is comfortable, whether it's AlphaV assets or any other combination. So what are the next steps? I want everyone to think about which household. It's very simple to onboard. If you're on a platform, we're on a dozen platforms today. It's easy to start using us today right on platform. If we're not on a platform, or you say, you know what, I want to do tax loss harvesting independently of the platform, we do direct index agreements. We'll customize your portfolio. You can tax loss harvest easily out of these equity portfolios, and we can help you with that. But at the end of the day, you're going to deliver disciplined growth to your client with a very clear risk narrative. And that really shows a lot of value that you're providing in your investment management portion of your practice. So the question is, if this all makes sense and agrees and you'd like to try it, think of that first client and that name and let's try and work together. Now, what about the overall economy, though? And what looks beyond the horizon economically? Well, economic growth remains positive, but it is decelerating. And though it's decelerating, and we have this situation of disinflation progressing, which is good, it's normalized. Services inflation still is persistent, too persistent for my liking. And we also have a monetary policy that's restrictive. But on the other side, coming in May, we have a new Fed chair that very much may alter the stance. And most likely, the betting odds are the new Fed chairman coming in will prop up equities significantly. So we should see that acceleration. That's why between our large cap, mid cap, SMID, and small cap portfolio for 2026, the large cap, I believe, will have another very, very strong year. And labor market normalization is going on and underway. It is slowing. A current unemployment rate posted is around 4.6%. So it's a little high. The participation range for employment is about 62%. So I think things are in general not any sharp declines, but it adds to an easing of wage pressures, and I think that generally will bode well for earnings. Consumer spending is showing a rotation, not a retreat, though consumer spending and debt is starting to tick up in certain periods. As I said, earnings growth is more selective in certain sectors. This all is kind of the backdrop that's a perfect setup 2026 for what we're recommending. Though this is another unusual one. I think most of us would agree. You do have these random events like we experienced last week where you have drives market sensitivity. But again, it's very much event based and things tend to bounce back and forth quite quickly. So my bottom line, as I sit here now with all the data that we analyze and look at and debate every day, is there's a lot of global economic uncertainties. Of course, there's a potential for a lot of rapid policy change. It makes sense. Be diversified, be globally diversified, along with the US diversification. So multiple assets across multiple countries, economies, currencies makes sense. And I would also expect drawdown events. They're going to be potentially much sharper than we're used to in prior periods. So that's it. Hopefully, I kept pretty close to my time, Keith. Again, appreciate everything and appreciate everyone here. Reach out, give me a call if there are questions. Happy to get into some questions now. We're going to depth offline. You can scan that QR code and book a meeting directly with myself.
Yeah, Lee, I also put into the chat the booking link for everyone there. So if you would like to chat with Lee and his team, I mean, please feel free. As a marketing guy, I got to put my red hat back on. Sorry. As a marketing guy, as you're talking, Lee, I'm sitting here thinking all the lead generation opportunities. I think about the story that you just shared and how well that translates in a seminar or a workshop or a radio show and those kind of things. So, I mean, that's the kind of hat I wear and the viewpoint that I have. That was to me tremendous and very insightful, and it was easy to follow. And
Thank you.
that's the thing in marketing, right? If it's easy to follow and it's communicable, people will move forward. All right. Well, let me start sharing my screen here, and we'll dive into some marketing things for just a minute. And really, how can you use some of the things that Lee was just talking about? Let's see, where are we at here? Well, I thought I was going to share. Yeah, I might have to open this up in a different way. Hold on one sec, everybody.
No problem. While Keith is pulling that up, everyone, if there are any questions, just drop them in the chat, or I don't know, Carly, if you're able to pull them up, ask away. Feel free, folks, and thanks again for the time and any feedback. And if you think it's great, love to know that. But even more importantly, other perspectives. Everyone's crystal ball is about the same these days, and we just trust in the data.